Primary and secondary market. We all know that the primary market is the part of the capital markets that deal with the issuance of new securities. In this lesson, we will learn primary market and secondary market, describe the role of primary and secondary market, the terms like anomalies, bubbles, Petersberg paradox, and information economics. After going through this presentation, you should be able to discuss primary market and its role, describe methods of issuing securities in primary market, explain secondary market and its role, define margin trading, listing and trading system in stock market, analyze the instruments of capital market, understand anomalies, bubbles, Petersberg paradox, and information economics. The primary market is that part of the capital market that deals with the issue of new securities. Companies, governments, or public sector institutions can obtain funding through the sale of a new stock or bond issue. The primary market provides the channel for sale of new securities. Primary market provides opportunity to issuers of securities, government as well as corporates, to raise resources to meet their requirements of investment and or discharge some obligation. They may issue the securities at face value or at a discount or premium, and these securities may take a variety of forms such as equity, debt, etc. They may issue the securities in domestic market and or international market. The process of selling new issues to investors is called underwriting. The different methods of share issues are private placement and public offering. In private placement, issuing firm sells securities directly to institution or other investors. In public offering, issuing firm sells securities to investment bank, who then sells them to individual investors. Public offering consists of competitive bid, means several investment banks bid to purchase the issue from the firm. Second, negotiated purchase means the issuing firm selects an investment bank. Third, direct sale means the issuing firm sells securities to the public without an investment bank. Fourth, underwritten issue. It is a type of negotiated purchase. In underwritten issue, investment bank buys the issue from the firm at a certain price. Next is best efforts. Investment bank tries to sell the issue for a fixed commission. Privileged subscription. Investment bank helps the firm sell the issue to a select group of investors. The secondary market is the financial market where previously issued securities and financial instruments such as stock, bonds, options, and futures are bought and sold. Secondary market has an important role to play behind the developments of an efficient capital market. Evaluation of securities, safety in dealing and mobilization of saving, price stability, economic barometer, and facilities of speculation are the roles of stock exchange. Stock exchange is an open market appraisal based on a compromise between the opinions of willing buyers and willing sellers. The provision of Securities Contract Regulation Act provides an element of safety to the investors. The task of mobilizing savings and directing them into productive uses is an important function. Through the price quotations, stock exchange helps in canalizing national saving from less profitable to most profitable sectors of economy. The presence of a large number of buyers and sellers of securities, demand for and supply of different securities tend to equalize, thus eliminating the chances of sudden fluctuation in prices. The stock exchange provides opportunities to shrewd businessmen to speculate and reap profits from fluctuations in security prices. Trading on stock exchanges is done through brokers and dealers. Commission broker, dealer in non-cleared securities, and security dealer are the participants of stock market. Margin trading occurs when investors who purchase stocks on margin borrow part of the purchase price of the stock from their brokers and leave purchased stocks with the brokerage firm in street name because the securities are used as collateral for the loan. Percentage margin is the ratio of the net worth or equity value of the account to the market value of the securities. Maintenance margin is the required proportion of your equity to the total value of the stock. It protects the broker if the stock price declines. Next is margin call. Listing of shares on a stock exchange means such shares can be bought and sold in stock exchange. Once the shares are listed and then are divided into two categories. Group A. Shares are referred to as cleared securities or specified shares. Group A shares represent companies with huge amount of capital and equally a large scope for investment. Group B shares are referred to as non-cleared securities or non-specified shares. Whenever a share is moved from Group B to Group A, its market price rises. Likewise, when a share is shifted from Group A to Group B, its market price declines. There are a number of capital market instruments used for market trade, including stocks, bonds, debentures, T-bills, foreign exchange, fixed deposits, and others. Equity share is a share that gives equal right to holders. Equity shareholders have to share the reward and risk associated with ownership of company. Preference share capital gives certain privileges to its holders on the equity shareholders. Cumulative preference shares, non-cumulative preference shares, convertible preference shares, redeemable preference shares, and participating preference shares are different types of preference shares. In cumulative preference shares, the dividend payable every year becomes a first claim while declaring dividend by the company. Debentures are the debt instruments which are issued by companies to raise long-term debts. Bearer debentures are registered and are payable to the bearer. They are negotiable instruments and are transferable by delivery. Debentures which create a change on the assets of the company which may be fixed or floating are known as secured debentures. Debentures which are issued without any change on assets are unsecured or naked debentures. When debentures are irredeemable, they are called perpetual. Perpetual debentures cannot be issued in India at present. A market anomaly or inefficiency is a price and/or return distortion on a financial market. It is usually related to either structural factors or behavioral biases by economic agents. Anomalies sometimes refer to phenomena contradicting the efficient market hypothesis. The main anomalies are: first, January effect. The January effect is a calendar-related anomaly in the financial market where financial security prices increase in the month of January. This creates an opportunity for investors to buy stock for lower prices before January and sell them after their value increases. Second, weekend effect. A phenomena in financial markets in which stock returns on Mondays are often significantly lower than those of the immediately preceding Friday. Small firm effect is related to a theory that holds that smaller firms or those companies with a small market capitalization outperform larger companies. The PE effect is a situation in which a portfolio with a lower average P or E ratio has a higher return when adjusted for risk than a portfolio with a higher ratio. Standard and Poor's Index Effect (S&P) is an index consisting of 500 stocks chosen for market size, liquidity, and industry grouping, among other factors. The S&P 500 is designed to be a leading indicator of US equities and is meant to reflect the risk or return characteristics of the large cap universe. A stock market bubble is a type of economic bubble taking place in stock markets when market participants drive stock prices above their value in relation to some system of stock valuation. Proponents of market irrationality have pointed to market bubbles as a primary exhibit in the case against efficient markets. You can have bubbles in markets with only rational investors, and assessing whether a bubble is due to irrational investors is significantly more difficult than it looks from the outside. Stock market bubbles frequently produce Hot markets in initial public offerings, since investment bankers and their clients see opportunities to float new stock issues at inflated prices. Petersburg paradox is a paradox related to probability theory and decision theory. It is based on a particular lottery game that leads to a random variable with infinite expected value, that is, infinite expected payoff, but would nevertheless be considered to be worth only a very small few amount of money. The paradox can be resolved when the decision model is refined via the notion of marginal utility, and it is one origin of notions of utility functions and of marginal utility by taking into account the finite resources of the participants, or by noting that one simply cannot buy that which is not sold. Information economics, or the economics of information, is a branch of microeconomic theory that studies how information affects an economy and economic decisions. Information has special characteristics. It is easy to create but hard to trust. It is easy to spread but hard to control. It influences many decisions. The random walk hypothesis may be derived from the weak form efficient markets hypothesis, which is based on the assumption that market participants take full account of any information contained in past price movements. Now let us check if we have understood the various concepts discussed in this lesson clearly. Cumulative preference share is a document evidencing a debt or acknowledging it. Right or wrong? Wrong. Hybrid instruments are those which are created by combining the features of equity with bond preference and equity with bond preference and equity, etc. Right or wrong? Right. Debenture is a type of share in which the dividend payable every year becomes a first claim while declaring dividend by the company. Right or wrong? Wrong. Before we end, let us briefly revise what we have studied so far. In capital market, two types of market exists, primary and secondary. Primary market is also known as new issue market, and secondary market is known as stock exchange market. Role of supplying the capital is direct in the primary market and indirect in the secondary market. Equity share having voting rights at all general meetings of the company. These votes have the effect of controlling the management of the company. The commission broker executes buying and selling on the floor of the stock exchange. Percentage margin is the ratio of the net worth or equity value of the account to the market value of the securities. A debenture is a document evidencing a debt or acknowledging it, and any document which fulfills either of these conditions is a debenture. Participation in the IPO happens before the security is first traded on any of the stock markets.